Today, we will explore some of the key tax concepts when it comes to flipping residential real estate. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi state law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 10 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Real estate flipping is often described casually, but tax law treats it as a potentially complex business activity governed by facts and circumstances rather than mere assumptions and simple labels. Repeated buy, renovate, sell transactions generally resemble a trade or business, and this characterization determines whether profits are taxed as ordinary income or favorable capital gains, whether self employment tax will apply, how costs are capitalized, and how federal, state, and local rules intersect. Small variations in your operational and financial pattern can dramatically change your tax posture. Most lay assumptions about favorable capital gains treatment or the principal residence exclusion are inapplicable to flips. Properties acquired with the intention of resale, improved materially, and marketed actively will often be treated as so-called dealer property rather than as investment property. Dealer classification produces ordinary income and exposure to self-employment tax. No single factor governs this analysis. Courts and the Federal Internal Revenue Service, or IRS, will evaluate the frequency of sales, renovation scale, marketing activity, acquisitive intent, use of short term financing, and the proximity between purchase and sale. Long holding periods alone do not guarantee favorable investor treatment. Rather, 1 year ownership is merely the starting point. Contemporaneous documentation and consistent treatment across accounting, tax returns, and financing materials are central to establishing and defending your position. Self-employment tax and payroll compliance often produce unexpectedly high effective tax rates. Profits from dealer activity are generally subject to Social Security and Medicare taxes, while the net investment income tax usually does not apply. Flippers who treat laborers as independent contractors without proper classification analysis risk sizable back payroll taxes, penalties, interest, and even criminal sanctions in extreme cases. Worker classification errors often correlate with poor books and records, therefore increasing audit exposure even more. Subchapter S corporation status may reduce self-employment tax through reasonable compensation planning, but only with rigorous documentation and consistent, disciplined accounting. Cost accounting is another high stakes area. Most renovation activity must be capitalized as improvements, increasing basis and cost of goods sold rather than producing current deductions. Interest expense during construction is often required to be capitalized. Correctly distinguishing repairs from improvements and correctly tracking indirect costs, utilities, and insurance requires disciplined job cost accounting. Interest capitalization rules depend upon designated production periods, and inconsistent treatment across properties invites adjustments upon examination. Entity selection shapes both tax exposure and liability. A single member limited liability company, or LLC, taxed as a sole proprietorship leaves profits subject to unenviable self employment tax. S corporations can reduce that exposure, but introduce complexity and eligibility limits and additional administrative burdens. Partnerships allow flexibility when multiple owners are involved, but further increase complexity and are not particularly tax efficient, at least with respect to self employment tax. Subchapter C corporations offer rather desirable rates, at least in certain cases, but raise the specter of double taxation and tax inefficient exits. Therefore, the optimal structure depends upon capital needs, exit strategy, risk tolerance, and operational scale. Some flippers attempt to quote unquote season properties by renting them briefly before sale. Good luck. Short term rentals rarely convert inventory into investment property, and the IRS often treats such efforts as insufficient and tax evasive. If depreciation is taken, recapture rules further complicate the tax outcome. Converting property from inventory to rental and vice versa requires precise documentation and careful basis adjustments. Section 1031 like kind exchange treatment is extremely rare for flips. Inventory held primarily for sale does not qualify for 1031 treatment, regardless of intermediaries or closing structure. Do not be fooled. Short rental periods before resale are not sufficient to establish investment intent. Attempting to shoehorn flips into 1031 structures frequently results in disallowed deferral, penalties, and costly adjustments. State and local taxes add another layer of complexity. Real property income is generally sourced to the locale where the property sits, even for non-resident owners. Think about that for a minute. Transfer taxes, recording fees, gross receipts taxes, and non-resident withholding regimes all affect cash flow. Sales and use tax on materials and certain labor may apply, and states increasingly cross-reference permit data, supplier audits, and recording databases to identify unregistered and untaxed activity. Accounting method selection and potential unicap obligations further affect timing of income and deductions. Even small operators benefit from property level ledgers, monthly reconciliations, and capitalization policies that reflect economic reality. Poor accounting often forces taxpayers to pay tax on phantom profits or lose valuable basis increases. Losses from flips are also constrained by at risk rules, passive activity rules, and net operating loss limitations. Financing structures, guarantees, and participation levels must be well and consistently documented, and assumptions that losses will automatically offset other income are usually incorrect. Exit strategy planning must consider that installment sales generally do not apply to inventory. Assignments or wholesaling introduce separate tax characterization issues beyond the scope of today's presentation. Timing decisions regarding listing, construction cutoff, and year-end expenses can materially alter tax liability. Tax examinations of flippers commonly focus on misclassification of inventory, improper capitalization, payroll and 1099 compliance failures, and mismatches between tax filings and real-world evidence such as permits, marketing materials, and lender draws. Misconceptions include believing a late S corporation election eliminates prior self-employment tax, assuming a 1-year holding period alone secures capital gains treatment, or treating temporary rentals as sufficient for 1031 eligibility. Those are all major mistakes. Real estate flipping can be profitable, but its tax landscape is unforgiving of informal practices and not for the faint of heart. Robust documentation, consistently applied structures, and disciplined accounting procedures are indispensable. A coordinated advisory bench combining tax counsel, legal counsel, accountants, insurance advisors, and transactional counsel is essential to convert gross project margins into durable after-tax returns. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.